Hello, this is the ChartProfit video. Friday 15th of Jan, we're about 3 hours into the trading day. This from the pre-open, we're looking at the E-mini S&P. End of last week we had aggressive selling here and here. Been looking for any signs of significant or effective buying this week. Been saying nothing would impress me that much until we saw some time printed back above the halfway point 1965.25 up here. What we've had this week instead, Monday through Thursday, is basically overlapping value areas that you see here. And as I mentioned pre-open today, till we see some sign of effective buying activity, I will assume this is sellers resting. So previously sellers have been and most likely are still in control of the day frame. We've seen this activity, as I pointed out earlier, the aggressive selling with the market coming effectively lower. And just this period here, the sellers, I think, resting, looking for some kind of response from the buyers. Thursday intraday, we had some buying here. These numbers indicate buying activity. We had a lower open. Market came quickly back, but the value area is inside the previous day. So buying and selling this week, the intraday sort of day frame activity has been pretty ineffective from both parties. As I said, most likely sellers resting. The other longer term analysis, where we look at the price oscillator, the momentum that remained down for all four major stock index ETFs. Breadth numbers are really poor. Really at levels that you'd call oversold, and we're looking for a bounce. I would have thought if we were going to see that from those oversold levels, we'd see it in here, but thus far we've seen nothing. So until on the lower time frame, this one here, we see something effective from the buyers, it's best to be safe and wait for evidence for the long side. As far as sentiment goes, my version of the Ridex assets ratio has come lower this week. There was a lack of fear previous to that in the Ridex ratio. We've seen a bit now. It's down at 5, just over 5, which is a 58-day low. So I said some fear has been registered in this indicator. And when we look at the bulls percentage here from the AAII public poll, that came in at 17.9%. That's an extremely low number. Last time we saw a bulls percentage that low was actually in April 2005. This indicator, the VIX, however, as I mentioned here, registering a surprising level of complacency. It closed at 23, just below 24 on Thursday, almost the same as 1 month ago before the current sell-off started. Spike in the VIX would be useful for the bulls. We're currently trading down here somewhere, some green being marked from the buyers, and then price printing back above this halfway point up here. That's the kind of thing I want to see if I was going to consider the long side, but I've seen nothing yet. If we look at the pulse chart, early in November we moved into this kind of area here where the price oscillator went negative at this point, and the breadth has been red across here. We had a couple of counter trend, if you like, attempts at buying. As soon as the sellers resumed in this sort of environment, as we mentioned last week, it came swiftly lower. So interesting, I think, that we had this rally from the 187 times support down here, marked at the time, up to this level here, just above 209. Again, that's the resistance from the time support, and now we're back down here. So 187 times support on the spider, and this is the current chart. So here's 187, previous support here. We just saw the violent spike below it and recovery over here. And so we can safely call this a key chart going into next week, and time down here would be a real negative. Ideally, we'd see a rejection from this level and price starting to pick up and so show some signs of strength. Let's hope for that. So we just look at the daily breadth indicators through yesterday for New York. This indicator at the top, the 10-day moving average of the net volume percent, really oversold here, as is the percentage stocks greater than their 50-day moving average, very low indeed. And this indicator here, 5-day moving average of the net new highs 25 indicator in black, all of these indicating really oversold levels, and we're at support on the spider. So I'll look at the sentiment indicators now. This is my version of the Ridex assets ratio. At this point here, look at the S&P at the top here, the ratio was up above 8, and we said at the time that that was usually not bullish in the short term, simply because there was this lack of fear being registered. So the SPY to the S&P had come off this much at that point, and the ratio was up kind of around the highs. Subsequently, we've fallen in the S&P, that's decline, and we've broken here down to what is now a level below 5 or at 5 and a 58-day low. So there is some fear here. Looking at that in a little more detail, at the top you see the spider, and I've marked a level here which is 9% down from a 50-day high, so you can see the extent of the correction. We have the ratio at the bottom here, and in the middle an indicator showing the decline in the ratio from the high point of the last 50 days. So right now we're down from the recent peak, which was here. We're down slightly more than 40%, so that blue line there representing a 40% decline, and that was the worrying thing up here, because we hadn't really seen much of a decline at all. In other words, no fear. So we're down now at levels where we've seen lows put in on the market, sort of 9% or close corrections, bringing in a low when we see a reasonable response or decline in the ratio. This chart you've seen before shows the total assets that I follow from Ridex rather than the ratio itself. At the bottom here, just sketched in a horizontal line, and a line showing a 6% decline from the 50-day high in the S&P, and you can see these points here and here and obviously here, and currently total assets usually run down to this level at that point. Look back on some more history. This is back to 2014, this back to 2012. This line, same line at the bottom here, again you can see corrections more than 6%. In this bull market that we've had, quite consistently we've seen the total assets fall back down below that level at least. So let's just look where we are now, just to remind you. We're a little above that level, just indicates the possibility that we're not quite there. Yeah, that if this pattern holds up. This is the bull fund assets in isolation. A similar kind of thing. We've got a 6%, it's the same line actually at the top, a 6% correction from a 50-day high in the S&P. Bull funds in total normally fall down to this line, as you can see, bringing in the low. We're not quite there yet. As of yesterday, we weren't. Here's the public poll from AAII. The red histogram at the bottom here is bulls minus bears. You can see this is a low number that we have down here. It's largely due to the bulls percentage, which is now below 18%, the lowest since April 2005. Extremely low level of optimism amongst the retail traders in this poll. Investors Intelligence poll, bulls percent lower at 28.6, a 15-week low. Bears percent rose to 35.7. That's the highest since 2011. Obviously that gives us a negative bar over here, because the bears are now higher than the bulls. Active money managers, we're looking here at the exposure index. That's a measure of the active money managers' current equity exposure. That number currently at 34.5. It's quite sharply lower this week. That's a 15-week low. Again, from this contrarian sentiment kind of analysis, we're not quite there in terms of this level, which has previously marked a point where the market turns back up, and that's down around 30. This is IWM, the Russell 2000 ETF, a rather worrying chart looking longer term. These two dotted lines here representing the value area highs and lows of a really long-term price distribution, of which the point of control, or the major controlling price, was at 115.35. We have now broken sharply below that value area low. Previously that had marked the point where the Russell started to move higher, and here at the value area high where it started to turn down, and that was the worrying bit there when we turned down, saw a lower high from the point of control. So we're in, I think, a new distribution at this point, and even if we see a rally back and a new controlling price starting to emerge somewhere, this distribution, which was still developing at these points, now looks as though we're into something new here. Looking at bonds, this is IEF, the 7 to 10 year ETF. We've been saying for quite a while now that a solid break above the 18-month controlling price here and the major down here at 105, both of which were giving us support and resistance. We said that solid break above or below those two levels would likely mark the next directional move. Certainly looks as though that is now up for bonds. If you've been following the pre-open each day, you know my view on gold for months. We are still looking for some indications that gold might start to show some signs that it's bottomed and some positive price action. We haven't seen it yet. If you look around at some of the other commodities, you know that we made a big point of the fact that copper, for instance, here the futures have broken below that level, which put it in an extremely weak price indication location. And from my way of looking at things, when you look at the longer term charts, it's really concerning. As we said, when it broke below that, this is really not a good pattern. And of course here oil, we're hitting a new low today over here. Much of the focus for the equity markets is looking at this chart, and obviously nobody's currently liking what they're seeing here. Like the charts we've just been looking at, you probably expect the dollar maybe to be pushing up, testing the recent high. We're not quite seeing that. I did say last week that I think we're working through a distribution where the index might well stay in this range, which it has this week, with the possibility of lifting this point of control higher. Now that would be interesting. That actually hasn't happened yet. I remain long-term bullish on the dollar until we see minimum this level broken down, which is the halfway point across this range that we're looking at. Longer term, the dollar index down here would be really weak. I'm expecting that we hold above this level. There's some consolidation, the point of control rallies, and then we see a new high. That's my current best guess scenario. You can see the importance of the halfway point from this here. After it hit the low, then the halfway came in here, so it's proven resistance, and now obviously with this pattern we're looking at the importance of that level. So that's my first line of support on this chart until and unless that point of control migrates up to here somewhere. And we also talked about the possibility of again last week, in last week's webcast, the Euro FX chart staying in this kind of area here, and this 12-month migrating lower. We're not quite there yet either, but I'm watching for that closely on both these charts. That would have me watching closely which way the market is moving away from that new controlling price if and when it happens. So we see the controlling price come lower to sort of in here somewhere, and then we start to see the Euro FX chart doing that. That would have me thinking we'll see a new low. The pound dollar chart much weaker, and we've discussed this in webcasts over the last few months, how this area up here was really strong resistance, and then we were watching from the high here to this low here and this halfway point, and we turned down from there down to the halfway point from here to here, which came in here, and then if you remember back, we did this. And a pattern we've discussed many times, from an important low to the high, you mark that halfway point, and we've talked about this lower high here being a really weak pattern. We talked about the Russell chart earlier, beginning a new distribution, I think, on the pound chart here as well. That is what we're seeing here, and it's a long-term pattern. I'm seeing the pound here breaking below value area lows, indicating that's what's happened here. And if we look at the Aussie dollar, if you remember back a couple of months ago, we were talking about the possibility of the chart forming a base in here. Seemed to be holding up better than other currencies. A couple of webcasts ago did say that we would have seen, rather I would have expected to see more upside from this chart if we were forming a base. I didn't like price action or where the minor point of control was migrating, so never saw anything like the price move we would have expected. And when the halfway point from the low once again broke down here, it moved back into an extremely weak position, as we mentioned last week. I said last week, if we did break to a new low, what ramifications would that have for gold? So continued weakness in this chart. Just back to the dollar index chart, we've been watching the halfway from that high, which comes in here. Instead of giving us a clear higher low or lower high, against that level, which is usually a good indication. We're instead seeing this oscillation around it, suggesting that maybe the level that we'll see a controlling price of some degree migrate to. Okay, final chart. This is the spider today. You can see where we are relative to the August low, and the VIX is actually popping today. Nothing like the spike we saw back over here, which temporarily got above 50 at this point. The VIX is jumping a little bit. Okay, so the spider probing its support once again at the end of this week at 187. Okay, that concludes. Have a good break, and thank you for watching.